diversify across different vintages. You commit to a program that is like a 10-year program, and you diversify across vintages, and you aim to look for managers who you think have the operation capabilities and also the ability to look into the valuations, buying at the right price, versus just the investor coming and picking this fund here and this fund there without really a portfolio approach to doing this.
That's exactly right. So diversification across several measures is really important. Vintage years is very important because we know there are good vintages and bad vintages and things in the middle, and you don't really know for 5 or 10 years which is which. Although if you've done this a while, you can have a feeling and you can look at signs whether you have a headwind or a tailwind, I like to call it. You want to be invested, diversified across managers. Some have a good fund, some have a bad fund. It's not that a great firm necessarily always has a great fund, and there's always up and comers, and there's always great firms that have seen their best days. Across sectors, certain sectors get very hot. They're justified in being hot. Other times it's just a distraction. It's just a sort of a trend that doesn't live up to the promise. There's always a set of trends. AI right now is all the rage, wasn't even on anybody's radar, 3-4 years ago. Clean tech, I mean, you can go nanotechnologies, you can go through these things. So it's very important. Sort of a less experienced investor will, human nature is involved. I'm a big believer in sort of behavioral finance, and human emotions take over. So, it's natural to want to do the hottest, latest thing, or during boom times when fear of missing out is a strong sort of pull, diving in more than you have, right? And then when the world's scary, why did I do this in the first place? I'm never going to do this again. You see this in the stock market as well, but it's more challenging in the private markets because of illiquidity and the inability to get out of things. So all these things are very important: vintage diversification, manager diversification, strategy, and then overall keeping a really, really high bar in terms of the quality of managers. And that's not as simple as just going and doing the short list of great managers. One, those are hard to get into. Some are impossible to get into. But in any moment in time, in any vintage, the best, the top quartile, top decile managers will be a collection of, established managers that continue to perform well, but also some established managers that have fallen off their horse. Up and comers that are destined for a long run, but also some up and comers that were one-hit wonders. They just got lucky. There's not a convenient list to go to and a convenient sort of cookie cutter playbook. This is where experience over long periods of time and up and down cycles and sort of a pure focus on it, again, like other professions, pays off. It keeps you out of trouble too.